America seems flush with wealth. Skyscrapers of glass reflect a booming economy. Yet beneath the surface, most of the money, i.e., NT, cash, or gold at all, it has numbers in computers. Today, roughly 97% of US money exists as bank deposits, electronic entries, not as paper notes or coins. The Fed reports only about $2.3 trillion in physical currency is circulating, while the broad money supply M2 tops $22.3 trillion. In other words, for every $100 of recorded money, only about $10 is tangible. If money is real, why is almost all of it invisible, merely promises in an account? For most of its history, money was backed by hard assets. Under the old gold standard, every dollar had a weight of gold behind it. During World War II, Bretton Woods pegged the dollar at $35 per ounce of gold, but confidence faltered. In 1971, President Nixon abruptly ended dollar convertibility to gold, effectively shattering the gold standard. By then, no country still used gold. Even Britain had left it by 1931, and the US by 1933. From that point on, the dollar became pure fiat currency, backed only by government decree and public trust. Banks also transformed. Originally, banks were safes for your coins. Over the 20th century, they became money factories. The Federal Reserve was created in 1913 to stabilize finance, but it didn't print most money. Commercial banks did. Thanks to fractional reserve banking, banks hold only a fraction of deposits in reserve and lend out the rest. This means the system's stability comes from confidence in banks and government, not from gold reserves. In practice, trust in the system became the new backing. The US can issue dollars beyond any gold limit because it relies on faith that the debt-based promises will be honored. Imagine you deposit $1,000 into a bank. The bank is required to keep only a fraction, say 10% on hand. They loans out the other $900 to someone buying a house, a car, or starting a business. Those borrowers then spend that $900 and the money ends up deposited in other banks. Now those banks can loan out 90% of $900 or $810 again, over and over. Each deposit is lent out and the result, the original $1,000 deposit has generated nearly $9,000 in new loans circulating in the economy. Each loan created a matching deposit. In effect, the banking system multiplies money out of thin air. This isn't theoretical, it's how credit works every day. When any bank makes a loan, it simply credits the borrower's account with a deposit. No suitcase of cash changes hands. At that instant, new money exists. For example, when a bank issues a $200,000 mortgage, it doesn't hand over $200,000 in bills. It writes a $200,000 balance into the homebuyer's account. That entry is money, an electronic IOU created by the bank. In this system, most money never appears in coin or paper form. It lives in spreadsheets and account balances. In fact, 97% of the US money supply is already bank deposit balances. Every swipe of a credit card or digital transfer just moves these digital dollars around. When we pay with our phones or swipe cards, we're shifting these IOUs from one account to another. Banks also borrow and lend among themselves, layering credit on top of credit. They might secure short-term loans using existing loans as collateral, or slice debts into securities, mortgage-backed bonds, derivatives, etc., that get bought and sold. This web of credit creates leverage, debts built upon debts. The total of these promises dwarfs any tangible wealth. Between bank deposits, corporate bonds, mortgages, and financial derivatives, the liabilities, the IOUs in the system, far exceed actual cash. The system's complexity is built on legal financial practices that obscure just how much debt is being rolled along. For instance, most debt isn't repaid in cash, it's refinanced or extended. A family refinances a mortgage and tacks on another decade of payments, effectively rolling old debt into new loans. Student loans are often deferred or income-based, growing over time. Credit cards allow minimum payments, so borrowers feel safe, even though interest keeps piling up. Legally, this rollover of debt keeps borrowers afloat, but it also ensures obligations never truly vanish. They just keep moving forward. Meanwhile, asset prices inflate even when incomes don't. Home prices, stock values, and commodities have surged, but wages for average workers have barely budged. The result is that true wealth feels concentrated in things you own, not what you earn. As housing and stock values inflate, it looks like the economy is growing, but much of that growth is just rising debt-backed asset prices. Workers earn almost the same inflation-adjusted salary they did 40 years ago, but have to borrow more just to buy a house or education. The financial industry also creates ever more complex products. Mortgages get sliced into bonds, which get grouped into new securities, CDOs, with risks buried deep in the paperwork. Derivatives and swaps weave networks of obligation between banks and hedge funds. All these instruments are legal, but they mask where the real risks lie. A loss on one loan can ripple through many firms half a world away, yet the web of contracts dilutes direct responsibility. In short, this system's opacity and complexity make it hard to see who really holds the IOUs and where a failure might start. This is organized complexity, not conspiracy. Everyone follows the rules, but the effect is that ordinary borrowers have debt, while profits and losses slide across faceless layers of finance. For ordinary people, the invisible debt machine means years of obligations and rising costs. Wages have stagnated. Real inflation-adjusted average pay is roughly the same it was 4 decades ago. While almost every essential expense climbs, higher education now comes with about $39,000 average student loan debt per buck, and families collectively carry about $1.8 trillion in student loans. A typical homeowner holds 6 figures of mortgage debt. When Americans get sick or want to start a business, they often borrow, pushing households deeper into loans. In total, U.S. households now shoulder roughly $18.6 trillion in debt, mortgages, student loans, auto loans, credit cards, and more. That's an average of about $105,000 per household. Many families feel trapped. Rent, tuition, healthcare, and living costs rise, but each pay raise only goes toward more interest payments on credit. Credit cards let families spend beyond income, but also mean minimum payments that keep people in perpetual indebtedness. Even when incomes inch up, debt grows faster, so workers rarely feel ahead. Small businesses see it too. To survive, many borrow for equipment or short-term operating costs. When the economy slows, loans make it hard to pivot. In all cases, cheap credit appears to help, but the real burden falls on the borrower in the end. For most Americans, life became a cycle of paychecks, servicing ever higher loans. The economy may look liquid and booming on the surface, but much of that apparent wealth is just debts being serviced. The arrangement relies entirely on confidence. If lenders start to doubt borrowers or vice versa, credit can freeze. In a panic, banks stop lending to each other and demand cash. Because everyone wants tangible assets, money markets can seize up, as they did in 2008, 2020, and other crises. When trust evaporates, the digital promises lose value and liquidity dries up. At that point, central banks and governments must step in with bailouts or bond buying to restore faith. The Fed might flood the system with reserves or guarantee bank loans. This relief effort temporarily patches the cracks and pumps the invisible money reservoir back up. Then, as calm returns, the cycle repeats. Credit expands again, and the economy hums until the next flare of doubt. These are familiar patterns in financial history, not the actions of a conspiracy. They reflect a system engineered to survive by expanding debt whenever it falters. In modern America, power rests not on piles of cash, but on chains of promises. Dollars in your wallet carry no weight without the electronic obligations that back them up. Major corporations, banks, and governments wield influence by controlling who owes what. When a corporation makes a deal, it is the promise of future payment that really matters. When a family buys a home, it is the mortgage contract that holds the value, not the paper deed. As a nation, the United States now runs on trust, the trust that these debts will be repaid. That trust can be as fragile as any agreement. We measure GDP and growth by dollars spent, but those dollars are mostly entries that someone owes. At the end of the day, the real question is chilling. If most money is just debt, what happens if people stop believing in the debt? The future of this system hinges on that quiet faith in the abstract promises that have become our nearest thing to real wealth. This isn't about crisis, it's about comprehension. If our world runs on debt, the first step is seeing it clearly.